Hello, and welcome back, guys. Hope you are preparing for a nice weekend. It's Friday today. And we're going to be taking a look at a company that most of you may not be aware of, and it is called OpenDoor Technologies. It's a home flipping business. So, what is home flipping or house flipping pretty much? Is basically buying a real estate and renovating it, making it better and selling it back for profit. So, I'm sure a lot of people have potentially even thought about doing that, especially if you are living in the US. It's a very well known thing, and a lot of people are doing it successfully, although it's not the easiest thing to do, of course. But OpenDoor Technologies does exactly that. We can take a look at the company analysis profile page, and you will see that it operates a digital platform for residential real estate in the United States, and the company's platform enables consumers to buy and sell a home online. And basically, they also do like this renovation stuff and all that. So people who are potentially thinking of entering this field and don't really want to do it themselves, they may consider buying stock in this company. Now, is this a buy? This one is actually up right now about 3%, but if you take it back 5 years, you will see that it has had a steep decline. At some point, it was more than $30, and right now it's sitting at 6.3. We will examine in detail why this is happening and whether this is an interesting buy right now. The first things to notice is that the P ratio right now is negative. It's the company is losing money, but it's been getting better is the thing. So we're getting a very low P ratio in the bigger numbers, or I should say the smaller numbers, and then kind of approaching zero or going into positive territory potentially. And the price to free cash flow positive and low here at 4 almost with outstanding shares being up because the company were issuing shares as the stock price was higher. But right now, I would anticipate that they would kind of like stop that or just do it in a much lesser curve, as you will see over here, because the stock price has been going down. And so, probably stockholders that are buying now are probably not going to be hurt so much as the ones before. Now, the company's revenue has been tremendous in terms of its growth, yet their net income has been going down, and we will talk about why in more detail later in this video. And you will see that the company again kind of losing money, so their net income margins are low. Now, I'm mentioning this company as a potential buy with the acknowledgement that it is a risky one. As you know, in this channel, we are generally speaking very conservative and we want to be going with proper investments. However, a a small part of a portfolio could potentially be allocated in opportunities that may be riskier because currently they, for instance, are not really making money, yet their price is not that bad, is not that high, indicating that it could actually yield substantial gains in the future. But again, you should acknowledge that there is some risk here with these kinds of companies. Now, what is going on with this one? Why am I mentioning it? So you will see in our stock news page here, and remember, you can find everything in. If you are a Patreon, you have full access to our tool, and you can become one by visiting the link in the description box below this video. And you will see that this is mentioned in quite a few articles here, like penny stocks to buy. It's not really a penny stock, but close. And small cap stocks. Yes. What is a better buy, Lemonade versus OpenDoor? So let's take a little bit of a look at what they are saying here. So shares of the home flipping company rose in response to falling inflation is what is happening right now with the stock price being up. Again, if we go back to our metrics page, you will see that currently the stock price, and yesterday as well, is up and it's getting a little bit steeper right now. So this is happening because investors are responding to falling inflation. Again, so the home flipping expert got a boost from the CPI report that showed inflation continuing to cool off. And obviously, since this is a company that is operating with houses, lower interest rates allow them to buy more homes, allow them to operate more efficiently and make more money. Okay, what else about the company, which is a better buy? There's an interesting article here talking about Lemonade and OpenDoor. Now, I have talked about Lemonade in the past. It used to be pretty expensive and losing tons of money. But what I wanted to focus on a little bit here is the case for OpenDoor. So what happened with OpenDoor here? So OpenDoor's revenue plunged 46% in 2020. And after the pandemic passed, the revenue soared to 211% to 8 billion in 2021, which we can kind of quickly take a little bit of a look at in our tool and the income statement. So that was 8 billion in 2021 and over here, and 8 billion in 2021, and also It bought 37,000, almost 37,000 homes during the year, which represented a 500% increase. And unfortunately, rising rates cut short the recovery pretty much, and revenue still rose 94% to 15.6 billion. Again, is what we're seeing here. So from 8 billion to 15.6 billion, a pretty significant increase here for the company, 94%. And so they are doing better, is the thing. And again, as you can see over here in the reports, they started with almost 2 billion back in 2018 and keep going higher and higher. So, they keep buying apartments or houses, I should say. And so this looks to be getting better and better. Now, their purchased homes dipped 5%, but still that's 35,000 units. That's compared to the previous year. And again, I do expect them to continue doing better and better here. And the problem with OpenDoor right now is that they are not making money. It's like what I mentioned earlier, and we saw it in the P ratio. And its net loss more than doubled from 662 million to 1.35 billion in 2022. Not surprising considering how capital intensive, yes, the business of buying, repairing, and selling is properties, and analysts expected to post a narrower loss, pretty much going back to this loss in 2023. So it looks like we could be having a similar picture to what we were seeing back in 2021, indicating that the company could still be subpar in terms of its stock price for a while, or investors could still flock regardless because we are out of the pretty much the pandemic years, and we're potentially even waiting for some interest declines eventually. So that's all worth taking a look at and analyzing a little bit. So the interesting things here: strong opening price and signs of recovery, but challenges remain here. Talking about the company and what is going on with them, and the strong revenue growth and the net profit margin of 8.69%, minus 8.69%. And it's something that we're going to be utilizing and we're going to be taking a look at in our stock evaluator. We will see the margins, and we'll have the handy table here which shows you the numbers here. 8.69 is what they did last year in terms of their margin. That's a loss. And so we're going to be taking all this into account. And also they expect to maintain a steady growth of 5.8%. Also worth noting because we are going to use this one as well. So very interesting things here about the company. And they did post back in February a $400 million loss in Q4, but they do see growth ahead. So this is what we're seeing right now for this company. It's a company that is losing money, yet things are getting better, and it does make tons of sales. That's interesting to see as well. Yeah, their net income is kind of going down. Now you will see here in our financial statements that the balance sheet of the company has obviously been affected by the fact that they were selling tons of stock with additional paid-in capital here. And the total equity of the company is sitting at $1 billion right now. In the cash flow statement, the net income started from losing money. And again, remember, this is a business that could be losing money for a while. And it looks like in 2023, we're going back to these numbers over here, is what the projections are, or similar to that, which is better than where we are right now. We could potentially expect the stock price to rise a little bit, maybe. And the operating cash flow was a little bit less than $1 billion for 2022. And the free cash flow, it was positive at 700 million over here. So now, what about our stock evaluator? What about the stock price? What does it make sense here? Now, again, remember what we saw, like 5.6% is the expect, 5.8% over the next 5 years. That's exactly what we want to know. So we're going to go 4.5, and actually let's go 5 and 5.5, since this was 5.8, the projected one. And this is actually maybe even too low. But the problem is the net income margins, because again, you'll see here that they are negative. So last year they were 8.7, as we saw, negative 8.7. And so we would have to anticipate some marginal profitability, otherwise it doesn't make sense at all. So I'm going to go 1, 2, and 3%, just the case where the company just becomes pretty much net income positive, which I think, based on what I'm seeing here, that it could take a while, maybe 2 or 3 years potentially, would be the best case scenario. And the free cash flow margin that I'm going to be using is, again, I don't have really solid numbers because the company has been posting negative profit. So I'm going to use something that is rather typical, 80, 90, and 100, and 13% for the annual return. And let's see what we're getting. So you will see that for the 4% in terms of revenue growth, we're getting $3 for medium, $7, and for high $12, with the current stock price being at 4 point something. I believe it's a little bit more right now because the stock price is up after pre-market. And so as it is right now, it becomes a little bit of an interesting proposition, and this is why I wanted to make this video, just to bring this to your knowledge. For somebody who is potentially willing to invest in this one, of course, you'd have to go with, some low amount of money. You don't want to go overboard for sure, but it can be one of the investments that you have in your sort of like riskier portfolio, because portfolios can and should be actually diversified with towards risk as well. And so it's fine to have like a percentage of a portfolio, like 5% or 10% in some situations, in riskier investments or smaller cap investments that have more risk, bear more risk. And so this one, I think it may be an interesting proposition, or it may be nice to actually have in a watch list and wait for it as the interest rates kind of calm down. It may actually become a very, very interesting target, and I think that's exactly what I'm going to be doing with it myself, actually, because I do like the fact that it's coming off of real highs here, like the $30. So it could be a multi-bagger potentially. Now, will this keep rising? It may be. So, maybe somebody, could miss out on waiting on this one. But again, it's not like the company is making tons of money. They're still losing money, yet projected to do better. So, a company that I definitely wanted to talk about and kind of give you some ideas here. Remember, of course, cash intensive company, debt intensive company, there is risk. Again, make sure that you understand that before potentially entering this one. But I did want to mention this specific one because it's a residentially reset as well. It's not a commercial one, which I would probably avoid. And I think that it has some merit, definitely some merit, and worthwhile talking about. Thanks for watching, guys. Tell me what you think about this company, and if you have any similar ones that you potentially think that they are doing better, it may be worthwhile mentioning as well in a comment below. Thanks again. See you soon. Bye bye.